What's up, everybody? Welcome back to Trades and Gains. I'm your host, Max Pitts, and yes, I am back from vacation. This week, we got a loaded week because we got geopolitics, Fed drama, oil FOMO, inflation clues, and we're going to wrap all this up into one chaotic week. The markets are currently juggling as it stands. U.S. strikes on Iran, oil spiking nearly 10%, Powell on deck with vague answers, the Fed's dot plot giving us whiplash and no clarity whatsoever, mind you. Core PCE could make or break September rate cut bets, and earnings/data laden week ahead that we're going to go ahead and break down. So let's go ahead and unpack this with context, sarcasm, and why you should give a shit, most importantly. Let's blast off here. So first things first, let's talk about our geopolitical flashpoint. First, U.S. strikes Iran. Yep, the headline pretty much says it all. Pretty much, you read what you see. Oil surged 10% off of this, and the market's absolutely shrugged. Oil drives inflation. This is why that matters. And inflation drives Fed behavior, obviously. Now, at $75 oil, it's a shrug. Now, if it hits $120, policymakers will begin to panic. Now, the flashpoint risk here is if Iran retaliates against U.S. targets or attacks shipping lanes, then instability is going to grow, the oil spikes will accelerate, and inflation becomes even more sticky than what it is now. Oil's current calm could be the calm before the storm. Keep eyes locked on geopolitical whispers, not just price triggers and targets. Now, we also have a Fed double header coming this week. Powell speaks not once, but twice. Not in dramatic TED Talk style, however, more like political debate deflection. So probably not going to be that interesting, but don't worry, I'll watch it and break it all down. We call it Fed Poker 101, though. Expect gaslighting phrases like balanced risk, data dependent, and no surprises. The dot plot split is bigger than midterm politics. 7 say no cuts, and 8 say let's slice twice. The inflation forecast is up, however, the growth forecast is down. The translation of all this, welcome to stagflation light, now with extra tariff uncertainty. Now, if Powell leaves ambiguity, expect a volatile trading week ahead. He needs to give clarity in order for this market to get some direction behind it. And that is the important thing that we all kind of forget sometimes. So, next thing we have is PCE. Friday, we got the big one. It's our big day. Forecast is expecting 2.6% year over year, but month over month is expected to stay the same at 0.1%. With year over year, we saw a 2.5% print last month. Now, why does this matter? This is the Fed's main inflation gauge. Hotter PCE is going to give us a weaker narrative for cuts, and stocks will have a vendetta. Cooler PCE will give us a fighting chance for a rate cut in September. We'll also see bonds rally, yields fade, and some equity relief start to take place. Now, the S&P 500 is stuck below its $6,144 level. The bridesmaid, never the bride syndrome to a T here. Is this normal? Yes. It's been just over a month since that 20% rally began. History says it takes 3 months to push through once you reach that level. Meaning bulls might get frustrated and start selling early. A choppy range equals your playground for tactical plays using EMAs, VWAP, previous demand zones, previous supply zones. You get the gist, but where there is chop, there is opportunity to enter into some longs or into some shorts. The choice is yours, but that is the best time to do it. A breakout above 6,144 could mean a fresh high. And this would be a momentum surge on top of that. So we could see some serious moves being made here. We've only been in range since May 12th. So go ahead, chill out. This is normal. We're okay. Now let's talk about the week ahead. So this week we have U.S. Chicago Fed National Activity Index. This is a gauge of economic activity. A soft print is a slowdown red flag here. S&P Global Manufacturing PMI, Services PMI, and Composite PMI. As you know, we cover this every week. Don't worry, we will again. But any sub 50 readings on these, contraction risk is creeping in. So we will see some downside if those come in sub 50. Earnings for that day, we have KB Homes and FactSet. Tuesday, June 25th, we have economic data. We have FHFA House Price Index. We have Case-Shiller 20-City Home Price Index. We have Conference Board Consumer Confidence, and we have Richmond Fed Manufacturing Index. Consumer confidence and home prices will be key for housing trades. Earnings, we have Carnival Cruise Lines, FedEx, and BlackBerry. Now, Wednesday, a little bit of a lighter day. MBA mortgage applications, new home sales, and building permits. Watch for signs the housing market is getting squeezed by high rates. So basically, if these numbers come in lower, we can assume that there's a squeeze coming in with housing because of these rates that people just can't afford at the end of the day. Now, on the earnings front, we have General Mills, Jeffries, Micron, Paychex, and Winnebago. Now, on Thursday, we have a heavy day again. It's Thursday and Friday are probably the two of the most, Monday, Thursday, Friday are three of the most important days this week. Thursday, we have GDP Q1, the third estimate. The expected is down 0.2%. Sounds bad, but we printed down 0.2% last month. Personal consumption, Q1, third estimate. Initial jobless claims, pending home sales month over month, durable good orders, wholesale inventories. If we have a GDP miss plus rising jobless claims, the Fed cut catalyst is now put in motion. Watch for an upside surprise and stagflation enters back into the chat. On the earnings front, we're seeing McCormick, Nike, and Walgreens. And Friday is the big one. We have PCE inflation. We have core PCE year over year. We have core PCE month over month. We have University of Michigan consumer sentiment. And mind you, this is one thing where consumer sentiment was down to 52.6 at one point. We haven't seen those levels since 2020. So the fact that we're looking at a 60.5 print here could mean there's some bullishness leaning towards this print on Friday. Kansas City Fed Services activity. We have personal income for May, and we have personal spending for May. If core PCE comes in hot, it's game over for September rate cuts, baby. That's what you need to understand. We want PCE to come in cool to fuel the bets for September rate cuts. It's as simple as that, folks. Now, let's talk this week's definition, which is a chop zone. Oil war, Fed indecision, inflation crosshairs, earnings jigsaw, but where's the chop? There's alpha. If you're playing smart, you're hedged. You're tactical, and you're not leaning one way too hard. If you just play what the chart is giving you and take your bias out of it, which is easier said than done, then you'll have some great opportunities this week, and I will be here to guide you through all of them, hopefully. You just interact, because I'm always happy to break stuff down for people. Now, go ahead and subscribe. Drop your one-liner hot takes in the comments. We'll pick the best ones in the videos this week, because we won't stop until the gains do, people. This is Max Pitts with Trades and Gains. I'm back, baby. Regular schedule programming. Stay weird, stay alert, and let your sarcasm be your portfolio shield. I'll see you guys tomorrow for our daily recap. Actually, I'll see you for PMI recap, midday options flow recap, and we will be on live from market open to market close, pulling options flow for all you beautiful people out there. Have a great Sunday, and I'll see you guys tomorrow.